This is our Forex blog for May 6, 2013, and for the last 6 or 7 years we pretty much have focused on using currency meters, which look something like this, with just the bottom part right here, for each currency that compared every, in this case, dollar pair to every other one, and statistically showed how strong or weak it was. And then underneath that we had the daily, weekly, monthly trend. Lately we've found an even better way of trading with the trend and also anticipating when counter trend moves are going to happen, and that's our currency indexes. This is the dollar index, the yen index, the euro index. And what an index lets you do, it actually creates a synthetic chart of all the euro pairs, for instance. And when you see a double top right here fail to go higher, that's a very big sign of a reversal. And you can just simply, when you see a little wedge pattern like that, sell the breakdown, which led to a huge move. The Swiss rallied up, found resistance at the previous day's high, wasn't able to get it above it for 2 hours, and then broke down right here. And that also is a very easy to spot and predictable move. If you're watching the currency and you can see the daily and weekly trend is down, it's likely to find resistance at the previous day's high when the longer term trend's down. There's obviously sellers on up moves for weak currencies and buyers on down moves in the pound because the daily and weekly trend's up. And so you have double tops, double bottoms, trend line breaks. You have multi-hour rectangle patterns, breakouts over the highest high of the day, which is right here at 10:30. You want to, in this case with the CAD, buy the CAD versus whatever's the weakest at 10:30. So let's scroll these charts back and look at it, what we would have seen when this was breaking out. As we go one bar into the future, you can see it's breaking out right here. The Swiss and the euro are also falling. So you could sell the euro versus the dollar because the dollar's going up. The yen's going up too, although the daily and weekly trend's down. So the euro-dollar sell is a better, higher probability than the euro-yen. The pound, which has been down, is now working its way up, and the longer-term trend's up. But this one's above its hourly moving average in gray. It's above the previous day's high in the CAD. So let's take a look at selling the euro CAD and buying the CAD Swiss. You want to buy the strong versus the weak and sell the weak versus the strong. It's that simple. So let's take a look at the euro CAD. 10:30, like I said, this currency was just slightly above or going above and below its hourly moving average. It wasn't able to make a higher high. These are all signs of not being very strong. You have nice little kind of wedge pattern that's starting to form right there, and you can see it fell right to our lower containment bands, and sometimes they can get down to our white 2.0 band and occasionally even underneath that. But also note the perfect oscillator indicator. When it gets to a -80, that's telling you it's gone at an extreme level and it's likely to reverse or go sideways. You can see the few times that those levels got hit today or even last night, the market kind of either it didn't really go higher, didn't really go lower. And a lot of times you get bounces off these levels, and you also most of the time get bounces off of the Bollinger Band around this. So when it hits here and here and here, not a bad place to look to sell, especially if you're a scalper. If you're looking to get 5 to 15, then sometimes to catch 30 to 50 pip move, it's very high probability. And it also, if you think the move is over and you're short right here and it's kind of drifting down and it's underneath the lower Bollinger Band, you can always keep tightening your stop above each bar's high, and then get out of the trade. Sometimes they go through here and they kind of go sideways. You just want to keep tightening your stop once it makes an explosive size move and get out right here. It allows you to pretty much catch the majority of moves. Now remember, the Swiss was also weak at the same time, so the CAD Swiss 10:30 very likely to go up, and this one was pretty much above its hourly moving average all day. It had a slight breakdown right here, came back above it, it was finding support right there. You have a nice little wedge pattern breakout, and again went from 92.90 all the way up to 20. Nice 30 pip move. And you're never going to catch every move, or every pip in every move, but your risk is about this. And even if you got out of this during the sideways consolidation here, you can see your wins bigger by a multiple of what your losses. If you want your losses to be small and you want your wins to be bigger. And again, looking at the perfect oscillator to know when to get out and maximize your profit. If you want to look to do a counter trend trade, you can see you had a good opportunity in an hour and a half here to make 20 pips on that trade as well. There was no other time when this hit the extreme. But another thing that you can do is if you do get a move down to the lower band when the trend's up, you can look to buy there. Now, there really wasn't at this point right here. This wasn't quite at the lower band because the volatility was so high, the bands separated. During low volatility times, the bands were closer. These Bollinger Bands on the perfect oscillator are much more accurate when the bands are wide apart. When they're close together like this, they're far less accurate. So I wouldn't take any trades when the bands are close. Same thing with regular Bollinger Bands and Keltners on charts. So let's look for some anticipatory trades. Like I said, trading is kind of common sense. The pound broke above its previous day's high. It failed and dropped. You can always draw your fibs on there to look to buy when the pound gets to the next level. You can see it went right to the 1.618 level. So at 9:30, pretty high probability place to be buying the pound. So what is likely to be either weak or likely to reverse weak at that time? Well, you could certainly do it against the Swiss because the daily and weekly trend's down. You can trade it against the Australian, which has a very weak daily and weekly trend. It's also underneath the previous day's low. So let's take a look at buying the pound Australian around 9:30. Now the Australian's going up right now, but it's likely to continue, either go sideways or go up slower than the pound is, because the pound, the longer term trend's up. It's not underneath the previous day's low there. It's a pretty high probability and anticipatory type of trade. We're going to be buying the pound Australian around 9:30. Now it's not the biggest trade in the world, but look at this trade. 9:30, you were anticipating a reversal. You also happen to have a perfect oscillator reading of an extreme, and you can see it shot up. I wouldn't say shot up, but it went up. If you had kind of bought it right there on a scalping basis, you typically will get in and put your stop a few pips underneath the low. It went up more by many multiples than your risk was. Also note the perfect oscillator on this chart. Most times where it hit the minus 80 or very close to the plus 80 are reversals. So let's take a look at some other ones here. One thing that I like is if a currency is kind of going in a sideways rectangle pattern. Let's take a look at some other ones. Obviously I showed you this one before, the CAD when it broke out right here, very high probability. The Swiss earlier when it was in a very nice range, and this is the weekly point of control. This is where most traders have positions for the previous week. You can see that the positions and all the Swiss pairs for the most part fell 20 pips from the week before. Not too radical. Sometimes you have them up and down 50 to 150 pips for the week. This one, all the Swiss pairs pretty much fell, but they fell very little next week. So if this was down 80 pips, you might not want to be buying this breakout because the daily and weekly trend is down. But because the previous week had such a tiny little down move where most traders have positions, this is a pretty high probability buy, and this is a great profit target because it's the previous day's high and the long-term trend is still down. So at 8 o'clock when it broke out right here, you would want to be buying the Swiss versus probably the weakest one, which was the Australian and or the New Zealand. Now I'd pick, it's kind of a hard decision here because the Australian has gone down more and the New Zealand's longer term trend is still slightly up at that time, but it is just breaking the previous day's low, which is a very key point. If you're able to and you can manage 2 or 3 trades at once, by all means do them both, because sometimes the one you think is going to work, you might make 5 to 15 pips, and the one you don't take moves 30 pips. And so I try, if I see 2 good trades, to take them both and trade smaller lots so I'm not as nervous. So let's take a look at what was the... Okay, so the Swiss is breaking out to the upside at 8. So we're talking about Australian Swiss sell at around 8. And you can see that this one was underneath the hourly all day. It wasn't able to get above the hourly, broke down. You obviously have the fib target down here as a decent profit target. And when you know your profit target's a decent amount of pips away, at 8 o'clock when this thing, and unfortunately it's already kind of drifting down. I don't like to sell currencies already falling. If I was actually watching this chart, I would have taken that little wedge pattern breakout a little bit early. But even even though you're chasing this currency, you have this is your potential profit target, and it can go farther than that. This is your risk. Put your stop right above that bar's, little mini swing high right here, and you can see the potential profit is 1.5 to 1.8, 2 times bigger than the risk, and it's worth taking. So let's take a look at the other one on here. The Swiss was breaking out. Now, keep in mind also that the Swiss, if the daily and weekly trend was up, this would be a much higher probability trade. I don't think I personally would have taken that previous trade, even though it worked, because the longer term trend was down and the profit target's so close. Let's take a look at selling the New Zealand Swiss as well. 8 o'clock. And I kind of like this one better because you can see it came down, found resistance, it went back up and it made a lower high than it did before, came back down and found support, and again made a lower high than it made before. You have a nice, beautiful little wedge pattern right here, and at 8 o'clock you're not chasing this one as much as you were the other one. So you draw your fibs on this previous move, and you can kind of eyeball it. This is your first profit target, this is your second approximately. You have, this is your risk, this is your potential reward, and it actually, in this case, moved down to the lower band. You have a profit of about 4.5 to 5 times what your risk was. And when you can get into a trade near the middle of the range, and you have a good chance of making, anywhere from 2 to 5 times your risk, if you're right, you got to pull the trigger. Now, don't worry so much about winning percentage. Worry more about having bigger wins and smaller losses. That's the real key to trading. And when you see a big move up and there's very little pullback at all, you can, I'm sorry, I didn't meant to draw a line on here. Kind of draw a trend line over there. When it breaks out, get long. Now, most people don't trade 2 o'clock in the afternoons, but this is a very high probability way of trading. Let's scroll back and look at some other ones throughout the day. You can just simply look at trend line breaks on these, especially when they, you have 1, 2, 3 points on there. You can another thing you can do for counter trend. Let's say you want to anticipate a trend. Let's put our trend tool on here where you draw the line and then it projects that trend line from the high. Because the yen is in a downtrend, the daily trend's down, the weekly trend's down, this is the previous day's high. A lot of times you have breakouts that are false. It goes, the market explodes up and then it reverses because there's not enough buyers at extreme highs. Nobody wants to pay up for something that is in a downtrend. Breakdowns underneath the previous day's low are much more likely to continue. There's more likely to be a breakdown than there is a breakout up because the longer term trend's down. You can actually draw these on your charts and trade with the trend as long as it's in the pattern, but as soon as it gets to the upper quadrant, look for sells at 7 o'clock right here. So what would be likely to go up at 7 o'clock on this chart? Well, the euro's trending up, and at 7 o'clock it looks okay, and you have pretty much, it looks like it could very easily break this trend line. You would be kind of anticipating a trend up, but it did go above the previous day's high, so it's certainly likely, very likely, to go up again. It doesn't mean it's going to continue up the rest of the day. As you can see, it double topped and then fell like a rock. At 7 o'clock, this one at that time does not look like it's going to go up. It broke out a little bit later. This one's certainly weak. At 7 o'clock, the CAD, it's above its previous day's high. You could certainly trade that one. So let's take a look at buying the euro yen at 7 o'clock and buying the CAD yen at 7 o'clock. And I'll end today's class with these. 7 o'clock, euro yen, it's very likely to go up. Doesn't mean how many pips you're going to make. Sometimes the trades that look amazing don't give you that many pips. But at 7 o'clock, here's a few things on your favor. The trend was up. It did have a breakdown, and it did unfortunately go underneath the hourly. But if you look at this area right here, it's underneath the lower Bollinger Band. It's also very close to the 80 level. Sometimes if the longer term trend's up, you can get into those. If you wanted to wait for it to go back above the hourly, which your profit potential is lower here, you can do that as well. So let's take a look at what in both scenarios. If you got into this trade kind of somewhere in this middle, this up bar here, your stop would be right underneath the low here, and you have a very good, you're never going to catch every pip, but if you made that much, this is what your risk is, that's what your profit is. if you had waited for it to go back above the hourly, which in some cases is a good thing to do. If the longer term trend's down, I would be a little bit more cautious. Put your stop underneath here, and you're never going to catch every pip, so you probably got out somewhere in here. Your risk and return is much less. Now that was the euro yen. Remember, the CAD yen's likely to make a bounce at 7 o'clock too, because the CAD is trending up and the yen is very likely to reverse. And so these are ways that you can anticipate future trend direction. This one was above the hourly, found support right here. You can buy it when it goes above that area here. This is kind of what your risk is, and it kind of works its way up. And a lot of times when you see moves that are just kind of grinding up like this, they're not strong enough to be near the upper Bollinger Band, you might want to look to get out of the trade. You also usually want to draw your fibs on the previous move down, and the 50 to 60% retracement level is a pretty good profit target. So if it stalled right here, I would have got out. If it, like it did, stalled here, you want to get out. If you're in right here and you got out of half your trade, at the 62% retracement, this is how much you made versus what your risk is. You're never going to catch every pip, so what I tend to do is when I'm in a trade like that, kind of get out where I think it's going to stall with the first half of my trade, and then I trail the second half. So it might be the stop is underneath the previous bar's low, and my average exit would have been somewhere in between here, and that's how much I would have made instead of the full amount. But you can see that amount right there is a multiple of the risk that's favorable. As long as your likely win to risk ratio is 1.5 to 2 times or more, you got to pull the trigger. It's that simple. So these are very predicting, and there's so many different ways of using it, and you can put any time frame in here you want. You can use 1 minute, 2 minutes, 5, 15, 30, 60, 240, any size you want. They work on daily charts, weekly charts as well. So you can use this for swing trading all the way down to scalping 3 to 5 pips over and over and over again throughout the day.